Hello and welcome to our latest Money Show Money Masters podcast segment. I'm Mike Larson, editor-in-chief at MoneyShow, and today I'm speaking with Peter Schiff, chief global strategist at Euro Pacific Asset Management. Welcome to the podcast, Peter.
Oh, thanks for having me on.
Hey, glad you could be here. As we sit here recording, the S&P 500's flirting with 5,000. Wall Street is celebrating Jay Powell for sticking a soft landing. Big tech's on fire, and so on and so on. Why shouldn't investors enjoy this? What are the bulls missing?
Well, they're missing quite a bit, but I think that the biggest mistake that they're making is believing that, the inflation genie is back in the bottle, that the Fed's policies worked, that they pulled off the soft landing. In fact, we didn't even land. We avoided recession entirely. Everything is great, and now the Fed could start cutting rates again. And the markets can just resume this huge run that they've been on, really ever since 2009, when the Fed started the policy of quantitative easing and 0% interest rates. And it seems that the markets think that this can continue indefinitely, but it can't. The Fed has not succeeded in putting the inflation genie back in the bottle, not even close. Yes, we did come down from 9% year-over-year inflation to a bit over 3%, but that's probably about as low as it's going to go. I think inflation has bottomed and it's headed back up, and we're headed back towards 9. In fact, we're going to go higher than 9. And we have a fiscal time bomb that's going to go off sometime soon as the national debt is rising by nearly $1 trillion a quarter. I think that we're probably already in recession. I think the idea that we've avoided one is absurd. I think the government numbers don't tell the whole story, and I think they're likely to be downwardly revised, 6 months, a year from now. That's what they did with the Great Recession, which started in December of 2007, but they didn't acknowledge it until December of 2008. The government went back and revised down a year's worth of rosy economic data, and then said, we've been in a recession the entire time. And it's quite possible that that's going to happen this time. In fact, that's probably why Biden is the most unpopular president in history. It's because the economy is in recession, and the statistics just don't bear that out, but the polls do, because the voters are expressing their frustration at the economy. And so I think what's going to happen is we're not going to get as many rate cuts as the markets are hoping for, because inflation is going to turn north, but the Fed is going to return to quantitative easing, which I think is an even bigger pivot than rate cuts, because I think the alternative is too big a disaster for the Fed to allow, because it would mean a worse financial crisis than 2008. And I think it would mean the U.S. government would be unable to service its debts. And so in order to, prevent a default or dramatic cuts to government spending to avoid default, I think the Fed is going to monetize the debts. I think we're going to go back to quantitative easing and abandon quantitative tightening. And I think, that's going to, collapse the dollar. I think it's going to send gold commodity prices through the roof, and it's going to be a big problem for the stock market.
Let's try and unpack each of those points one by one. Starting with the economy, after the Labor Department came out and said the economy added 353,000 jobs, on shiftgold.com and on your podcast, you called it another BS jobs report from the government. What's your message there? Why aren't these numbers really as strong as they look on the surface?
Well, we know that all of the jobs that have been created over the past year, probably longer, on balance have been part-time jobs. And so these are jobs that are replacing the full-time jobs that are being lost. The jobs that we're creating on a monthly basis are mostly going to people who already have jobs. So it's not that people who were unemployed are now working. It's that people who were already working are just working more. And why are so many Americans working more? I mean, we have a record number of people with two jobs, three jobs, two full-time jobs. And this is because the typical job can no longer provide a worker with enough purchasing power to make ends meet. The prices, the cost of living has gone up dramatically over the last few years, and that has forced a lot of people to moonlight. And as we've lost a lot of quality jobs, good paying jobs, I mean, look at the announced layoffs. I mean, all the big companies are laying people off. Yeah. So I'm not really sure who's doing all the hiring. But the jobs that are being lost are much higher paying jobs than the ones that we're gaining. And that's why people have to work 2 or 3 of those jobs to put food on the table or to pay the rent. So I don't think this is a sign of a strong economy when people are forced to work multiple jobs. I think it's a weak economy, and it's not even a strong labor market, because if the labor market was strong, workers could get raises, but they can't. They can't even keep up with inflation.
Let's talk about Powell for a minute here. You recently said when Jerome Powell talks, people shouldn't listen. And you were referencing his 60 Minutes appearance and kind of what Ben Bernanke used to say on 60 Minutes back in the day. What is the Fed reading wrong? What do you think that the Fed's getting wrong here and will for the rest of this year and beyond?
Well, I don't necessarily think the Fed is trying to get it right so much as they're kind of towing the party line. Ben Bernanke, in an interview after he was no longer Fed chairman, he was asked about a lot of the mistakes that he made, in particular, saying that the subprime problem was contained and that we didn't have to worry about it. And his response was, well, he wasn't really speaking his mind so much as towing the party line. He said that he was a member of the administration, which he was not, but he somehow felt that he was a member of the administration and felt obligated to put a positive spin on things. And so he said, look, just because I said not to worry and everything is great, it doesn't mean that that's what I really felt. I was just trying to put out a positive message in line with what the administration was saying. And so nobody really talked about that but me. I thought it was a pretty profound admission, but it was something that I had suspected all along, was that the Fed is more of an engine of propaganda than legitimate economic analysis. And so when you hear Jerome Powell talk about how we have a great economy, how we have a strong economy, he's saying that as a pseudo member of the Biden administration. And he's trying to help reelect his boss by pretending the economy is in much better shape than it really is. And maybe he knows that.
Let's talk a little bit about this sort of combination that, you have the term inflationary depression, weaker growth, but not weaker inflation along with it, or not negative growth, really. How does that come about? Traditional economic theory tells you, hey, growth's going to slow, inflation's going to slow, policy eases, and that solves the problem. Why do you look at things differently?
Well, it's not really economic theory. It's Keynesianism. And according to Keynes, if the economy is weak, then inflation is going to come down. But, Keynes got a lot of things wrong. And inflation is about money. It's a monetary phenomenon. It's got nothing to do with economic growth. It's the growth of the money supply. That's what inflation is. And when you have more money, prices are higher than when you have less money. When the economy grows, a real economic growth produces more goods and services, and that helps keep prices down. That can offset the impact that inflation has on pushing prices up. So it's really a strong economy that helps keep prices down, not the reverse. When you have a weak economy, if factories are producing fewer goods, if workers are providing fewer services, then prices will go up. And what really stokes inflation in a weak economy is not only do you have fewer goods and services being provided, but you have more money being printed because unemployed people get government benefits. They get, welfare payments or food stamps or stimulus checks. And so the government tends to print even more money and run even larger deficits, when the economy is weak than it does when it's stronger. And that is an inflationary force. So we have more money printing and less goods production. And so I think this next recession is really going to fuel the inflation fire, because it's going to start when the inflation is already elevated. And I think when the dollar really starts to tank, which I believe it will, that's going to dramatically accelerate the upward pressure on prices.
I definitely want to talk about markets that you follow closely, including precious metals. But before I get to that, let's talk stocks here. I mean, what is this? If this is your macro view, this is how you see things playing out. What does that mean for the stock market first?
Well, I think the growth stocks are in for a lot of trouble. A lot of these stocks that trade at very, very high multiples to their earnings, or they don't have any earnings at all, and they just trade at a multiple to their sales. So I think those stocks are going to come down quite a bit. But there are a lot of stocks that are probably going to do well in an inflationary environment as hedges against inflation, because people still need to find a refuge. You have to get out of paper, you have to get out of bonds, you have to get out of money markets, so you've got to put your money somewhere. So I do think that certain stocks will do well, but I think it's going to be the international stocks, particularly the emerging markets, that are going to be the primary beneficiary of the stagflation trade, of the move out of the US dollar. And of course, commodities will do very well. Companies that are involved in commodities, mining, agriculture, oil and gas, things like that, will do very well, as they did in the 1970s. They're going to do very well in the coming decade, probably even better than they did back then.
Let's talk about gold, the metal itself first. I mean, you noted that spot gold hasn't traded below $2,000 an ounce yet in 2024. And I think you noted it was the longest stretch of days over that benchmark that we've ever seen. So what's helping gold in this environment? What do you think's behind the bullish outlook there?
Well, look, I think gold is setting up for a big rally. But you don't see that in the gold mining stocks, which continue to be under a lot of pressure. There's a lot of fear in the investors when it comes to the mining stocks. So you don't have a lot of optimism. You don't have a lot of hype. It's just fear and doubt. And so I think that's a good combination to begin a bull market where you've shaken out so many weaker players. But I think the rise in the stock market, the S&P being above 5,000, or record highs in the Dow and the NASDAQ, are a detraction from gold. I think all the hype and the fanfare surrounding the Bitcoin ETFs, that's probably stealing some of gold's thunder. And so it's just an environment where nobody is paying attention, but the central banks continue to be the primary buyers, other than jewelry industry. But the central banks know what they're doing in this respect. They're preparing for de-dollarization. Central banks around the world are no longer accumulating dollars. They're buying gold instead. I think they're preparing for the day when the dollar is no longer the reserve currency, and that day is not too far off. And so gold, I think, is going to be dramatically repriced in that environment, and the American standard of living is going to be substantially reduced, and with that, the value of our equity markets. Our stock market has been on fire for the last 15 years relative to the rest of the world, but that's going to change.
It was such an interesting stat you had the other day that I think Meta platforms gained more in market cap in a single day than the 70% of the total market cap of the top 85 miners globally. I mean, that's an amazing thing that just shows the dichotomy of how much money and how much, I guess, excitement is here in this one part of the market versus another, right?
Yeah, I mean, the entire market cap of all the gold stocks doesn't even come close to the market cap of one of these magnificent seven stocks. So the entire industry has almost no value. It's just a rounding error in the market cap, and obviously that's not sustainable. This segment of the market is just much too cheap. It's been overlooked for a long time, and that's why I'm so overinvested, and I have been for a while. I mean, it's not like I'm just figuring this out. I was very early in this trade, and so I've been patient and I've been waiting and accumulating more. But I think there's a huge payday coming at the end of this. I think investors are going to be shocked by how much these stocks go up. Gold in the 1970s went from $35 an ounce at the beginning of the decade to over 800 by the end. So you'd have to have $50,000 gold to have a comparable percentage gain from 2000. And I don't know that gold's going all the way up to 50,000, but even if it goes to 10 or 20,000, right? I mean, that is just huge for these gold mining stocks. I mean, even a move up to 3,000 should be enough for these stocks to double or triple, maybe more. But I think the potential is much higher. And it's not just because of the inflation we've had in the past, but all the inflation that we're going to have in the future, because the alternative is just a political non-starter. Because the alternative to massive inflation is a deflation.
Yeah.
And they'll do everything they can to stop that. Because in the deflation, not only are the banks going to fail, and not only will we not be able to bail them out, but the depositors are going to lose money. Not just the investors, but the depositors. And the government is going to have to come clean with voters and tell them that they can't have their Social Security benefits. They can't have their Medicare benefits. There's just not enough money. And we're going to have to tell our bondholders, we can't pay you back. We might be able to pay you something, but we can't pay you everything. But I just don't see the politicians being that honest. And so inflation is the only viable path that we're going to follow. And so if you think inflation is bad now or was bad over the last couple of years, you ain't seen nothing yet. It's going to get a whole lot worse.
Dishonesty from a politician. When have we ever seen that? In any event, in the time we have left, Peter, you're going to be speaking at our Investment Master Symposium in Miami. Nominally, I know these things can change. Your topic title is going to be Endgame for the Fed. So in the last minute or two we have here, what do you see the endgame being? What's a sneak peek you might be able to share there?
Well, again, the end game is runaway inflation, maybe a dollar crisis, a sovereign debt crisis. Look, the Fed has never solved any of our problems. It's simply made them worse. The only tools it has is inflation. That's what they've done. So every time there's been an economic problem, the Fed has created inflation. Now, they called inflation, quantitative easing, reducing interest rates, but it all amounted to expanding the money supply, the credit supply. They inflated. And in so doing, they bought time. They allowed us to kick the can down the road and allowed the problems to get worse in the process. So instead of dealing with the problems with solutions that would have worked, but that would have been painful, we didn't deal with the problems. We allowed the problems to get worse because we were able to postpone a lot of the pain to some future date. And there is going to be a point, and we're probably very close to that point. And I don't know if we're going to be there by my talk in April. We'll see. But there's going to be a point where the Fed can't do that. And that is the end game. That's where, the truth is laid bare. And we see the inevitable consequences where we have the collapse of dollar, runaway inflation. And then there's nothing the Fed could do because all of its tools are inflation. And so if we have a dollar crisis and a sovereign debt crisis, and we have a banking crisis and the economy is in depression, is collapsing, what can the Fed do? What they did in the past that we thought worked won't work. It'll just make it worse. They can't add fuel to the fire by printing even more money when the problem is we got too much money. The problem is a loss of confidence in the dollar, and you don't instill confidence by creating even more. And so this is going to expose, decades of failed policy, of monetary policy mistakes that I've been one of the lone voices to publicly criticize. But the conventional media has rallied around the Fed and extolled the Fed chairmen as saviors of the economy, and they've done no wrong. but they are actually the architects of this coming disaster.
Well, Peter, it's a fascinating thesis. It's going to be a fascinating talk. I know that the people listening here are going to really be excited to hear what you have to say there. Again, everyone, Peter is going to be joining dozens of other top trading, investing, and economic experts at the Investment Masters Symposium. It's scheduled in Miami at the Hyatt Regency from April 10th to April 12th. You can check out some details in the link below. Peter, thank you so much for your time. Look forward to seeing you there in April.
All right, I'll see you then.